Do we ever stop learning lessons? Hopefully the hard ones, because when we learn hard lessons, it usually means we did something wrong, like lose a lot of money. Well, in option trading, like everything else in life, we really never stop learning. We're either learning and making money or dying and losing money. In today's video, I'm going to review the top 8 key option trading lessons that I have learned, confirmed, and added over the last year, and how you can use these rules to grow your option trading account quickly and safely. Hey guys, Darren here. We've got a great video for you here today. But first, before we get started, if you appreciate the time and effort that goes into making these videos, if you can do me one favor and hit the like and subscribe button, it really helps out the channel a lot, and I really appreciate it, so thank you very much. I think it's super important that we understand the different strategies and tools that the rich are using to get richer so that we can use those same strategies and tools and profit for ourselves in any market safely. Be sure and download the free options workshop in the link below. It talks about the 2 main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Lesson number 1, limit the number of underlines that you trade. I'm referring specifically to my option trading account. My 401k and longer term accounts are invested very conservatively, basically in the S&P 500 or total market. So I'm not talking about that account. I recommend you do the same and keep your long-term investments separate from your option trading account. I want to grow my option trading account like a business and multiply my money. However, for my options trading accounts, in the past, I've often traded way too many underlines. I traded everything. Whenever someone had a good idea with a hot trade and they said something that seemed like a logical reason to support the trade, I would jump right in and do the same trade. Not a good idea for several different reasons. How can you follow the fundamentals, the technicals, the news for all the different underlines? You'll be much more familiar with how those underlines move within different ranges, as well as how they react to earnings announcements and how easy or difficult they are to make money or not by trading fewer underlines. If you have too many stocks, then you aren't going to take advantage of your knowledge and effort that you put in studying the companies as much, since you'll basically just be in a mutual fund. Diversification can be good, but I like to have that in my long-term accounts as opposed to my option trading account, since that will limit my returns. I often even compare trades between different underlines, and if the IVR is higher in one than another, then I'll put another tranche on and go wider with an iron condor in the higher IVR stock underlying and close out the one with the lower IVR. Lesson number 2, scale in over time. I often look at the highs and lows for the day within my stock underlines. I typically don't want to go all in at once on any one trade. If I'm a 3-lot trader in a certain account, then I'll scale in and buy one at first. Then if the stock price moves against me and my bullish or bearish sentiment has not changed, I'll add another tranche and then a final 3rd position if it moves even further. I will also sort my positions by percentage gain for the day. If I'm long a certain position and it's the biggest loser for the day, then I look to add to it. If I'm bearish and the stock price is up big on the day, I may sell another call credit spread. If I liked it prior, then I'll like it even more at a better cost. It's just dollar cost averaging. Ensure that you are in line with your long-term strategy. So even though the market is down, that doesn't mean that I automatically am going to buy more stock, calls, or sell puts to go long. I still need to be bullish on that stock. Just as I scale into trades, I will scale out taking profits and closing long positions when the price moves up or down as well. On big up days, I'll be sure and close out some of my long positions. Lesson number 3, push out losers if tested to avoid large losses. I used to just wait when my losers were tested. I'd tell myself, yeah, things are going to turn around and the stock price is going to go my way soon. Just need a few more days. Rather than deal with that agony day in and day out, waiting for that to happen, I've learned to just close out and recenter my positions in the next monthly option cycle. My experience is that once the short strikes are tested, the remaining time left in the initial trade is usually not long enough for the stock price to turn around and occur. Also, as long as the short strikes are just hit and have not been blasted through, then we should be able to go ahead and roll out and adjust the strikes to expand our profit zone while still collecting additional premium. Lesson number 4, let winners run and continue to collect profits. Don't waste the homework done when I enter into trades. That's my motto. I've already checked the fundamentals, technicals, news, the conference calls, and earnings reports. I've decided on the trade position on the company. If the stock price goes my way, I don't just close out and take a 50% profit. I believe in my homework and I'm sticking with this because I deserve to make 80 or 90%. It also depends on the length of time that I'm in the trade. I'll sometimes take a smaller, a 50% profit if it's only been a day or two and there's still 30 or 40 days to expiration. Lesson number 5, the technicals and time frames. Use them. This year, I have incorporated technical levels much more within my trades, both at trade entry when the initial trade is placed and at the closing when I take off the trade. We want to enter long trades at support when the price is trending up in the short and the long term. We then also want to exit trades when we are approaching resistance and or when the stock price is trending down. I look at the long-term or the 5 to 10-year trend lines as well as the shorter-term monthly and weekly time frames. Lesson number 6, consider the macro overall market and be aware of the sector movement. I like to use sectorspiders.com to track the different sectors weekly as well as over the last year. This way, I can see the movement and have a good idea of what each of the different sectors within the market are doing and are expected to do in the next year. We want to be long in the sectors that are trending up and short in sectors trending down. I also watch CNBC and listen to what the so-called experts are saying. Then I decide for myself whether or not it makes sense for me and if I agree with them or not. I do want to hear their opinion, as to me, all information is good. Lesson number 7, always be aware of the risk on and ability to survive a black swan event. I have a spreadsheet that I use to help me to always know approximately how much risk I have on at any one time. Here's an example of my risk list. I try and update this weekly, which doesn't take too long since these are the core positions that I continually trade and mainly make fairly small adjustments. The symbols on the left is self-explanatory. Now, the downside risk, this is the most important factor and the reason that I do the spreadsheet. We're putting this spreadsheet together in order to always be aware of our risk of blowing up our account. The negative number reflects downside risk and loss that could happen should the market get hit and take maybe a 50% drop. The positive number in green reflects the gain that should the market make that drop down, this is the number that will offset the downside risk numbers. So these are short or negative delta weighted option trade positions. Notice that I'm not too worried about the market or any stock price rocketing straight up. It just doesn't do that. However, if it does, the positive deltas will help to reduce the loss to the upside. Also, notice the cap requirement is $47,000, and this is also the amount of BPR, which stands for buying power reduction, that I'm using in this roughly $61,000 account. So the remaining $14K is the option buying power showing available on the platform. Notice that the 47K BPR used plus the 14,000 available equals the 61,000 total account value. Now, under the notes section, each of the different strategies or trades will have different results. I'll put some notes in here. Iron condors will be small winners on the call side and full losers on the put side should the market drop. So overall, they will be losers. Leaps and poor man's covered calls will be losers, but maybe only by 30 or 40%, since there will still be 1 year plus for the stock prices to recover. Call spreads will be full 100% winners on a big downside move. Put spreads will be full 100% losers. The expected monthly gain. This is the gain should everything go our way. Not all of these will always be monthly winners, so I keep track of monthly winners and losers, actually weekly. Roll losers if bullish bearish sentiment has not changed and IVR is still high. That's what I do. The cap requirement is basically the buying power reduction, the BPR. The monthly ROC, or return on capital, is what I use to have an idea or an expectation of the monthly and the annual ROC, rate of return or return on capital that's expected should the trades go my direction, and the annual projected gain as well. The bottom line is on a big 40 to 50% down move in the market, the roughly 60K account will drop by $15,000 to $17,000. So 3 months of gains at $5,600 per month will easily cover the $15,000 of monthly risk. Then basically 9 months or 9 times $5,000 or 45 to 50K will be complete profit. At the end of the year, if there's no collapse, then the 61K could grow to 100K easily. My plan will be to never use more than 70% of my BPR. That's in a high implied volatility environment. In a lower IVR environment, lower than 20% IVs, then I typically don't want to use more than 50% of my available capital. All right, the last one, lesson number 8. Keep a trading log and trade proven winners and not losers. At the end of the week, on the weekend, I go through my trades and update my notes. I just keep a simple sheet with the items that I like to track, price and IVR, short-term monthly trading range, as well as long-term target price, news, earnings, and conference call notes, and monthly gains and gains over the last 365 days. I actually go over and cover all of these trades every week in my stock options weekly update videos. Be sure and check those out. I normally put those out on the weekends on a Saturday or Sunday to get you ready for the start of the week on Monday. This really allows me to review the trades that I have on with a fresh look every week, determine which ones are working and which ones are not. I may choose to close out certain trades or put more on in certain underlines. It's also nice to look at this when the market is closed and I'm not tied up in the live trading during the day. This trading log also clearly shows me the stocks that I have been successful in as well as the stocks that I have lost money in. And more importantly, it tells me the reasons why. Most often, the reasons why are the exact same reasons why I will continue to make money in the ones that did well. And at the same time, for the ones that I lost money in, most likely, if I keep trading them, then history will just repeat itself. All right, guys, I hope these lessons helped you out. Please let me know in the comments below the most important lesson that you've learned over the last year. Remember to hit like and subscribe, download the free options workshop. Thanks for watching. See you in the next one.